Right, how does the bond yield curve relate to the market? Here we're going to have a short talk discussion on the fixed income market, bond yields, the curve, flattening of the curve, inversion, and how they directly relate to the stock market and potentially currency market, and contagion could move through commodities and all asset classes. So as we get into this, let's have a look at some of the fixed income market key points. First of all, bonds are generating fixed income rates of return to the investor. Although these rates do move and fluctuate just like any other market, the ordering of these bonds are what is important. I don't mean like phoning up to order it. I mean the order that they come in, like 1, 2, 3, 4. And that specifically, the ordering of it is where we get the curve from. So we'll go through that with the chart in a minute so you can get a visual idea of how that curve is made up in the ordering, just so you can understand it before we get into it too much. The shorter the bond, the lower the yield generally. The longer you give the money, and it's held in the bond, the more you're likely to return out of that. Secondly, bonds are essentially just loans that are issued by governments or companies to fund their operations going forward. So they're used as a fundraising technique or vehicle, and that's what they are. It's a fundraising instrument. If you're not really aware of what a bond is basically an agreement between two parties that someone's going to borrow some money, pay it back with a percentage on top. Subprime lending, specifically in the mortgage sector, is what caused the 2008 financial meltdown. We had these CODs, which were basically like debt that had been collected together, and it was a lot of subprime debt, which means it was like a high chance that the person taking the loan couldn't pay it back. Whereas a prime loan it's actually the other way around. It's very improbable that the person taking the money would be unable to pay back the loan. So someone who already has very positive cash flow, very successful business, and so on. So what caused the financial meltdown in the mortgages is that all of this toxic subprime debt was being amalgamated together and sold in these packages and being traded on, and eventually those loans defaulted and it all went fell down in a pile of smoke, So and the last point here is fixed income accounts for a third, if not more, of most high net worth or ultra net worth portfolios, and is core practice in low risk, consistent growth fund management. And a lot of big bond traders out there only work in the bond market. They're not interested in commodities and volatile stocks and so on. So if it's not part of your portfolio, maybe you should think about buying a few bonds, because you can always bank on bonds. You can always be pretty much sure that you're going to get a return. Moving forward, the yield curve. Bonds are issued over a duration, typically ranging from 1 month to 30 years. So it can be like locking money away for a rainy day, or locking it away for your grandchildren. The Bible says wealth, we should put a third in the ground, and the bond is essentially the ground that you can put it in. Government bonds work in a tiered manner, meaning the longer the bond, typically higher the yield. So like I'm saying, 1 month bond, you're not going to get as much money as you would if you give it someone for 30 years. And every way along that spectrum of duration, we have 1 month, we have 3 months, we have expiration of a year, a 3-year, 5-year, 7-year, 10-year, and a 30-year, and many others. So due to these tiers, we see a curve appear, going higher in yield along the duration. In layman's terms, when there's an upward yield curve, we consider the economy is in growth and inflationary, not in a recession. With a downward yield curve, we can assume a recession is imminent, if not already begun. Now, you must understand that this is essentially the horse in front of the cart. The bonds are the horsepower, the stocks and everything is what's being loaded up in the cart. If the horse suddenly goes lame, the cart's not going anywhere, it's going to drop some apples, right? So going to drop some of the loads off that heavy wagon. So the bonds, if they cannot be pulled forward and we start seeing a recession in them, essentially that the yield curve has flattened or inverted, then we can take that as a leading indicator. And remember, it's lagging a bit because a change in the bonds isn't instantly going to be updated in pricing in other asset markets. Why is that? Well, bonds give us access to credit. If you're an SME or a big enterprise, it doesn't matter, you're a lemonade shop or not. You want to scale, you have a cash flow, you're making 100K a day, but you want to make $1 million, you're going to need to scale your operation. And that means fundraising. You can sell a share, you don't want to do it, you want to issue a bond. You know you can get the money back, right? So that's why bonds have always been attractive. Same for agriculture, people want to expand, more fields, more machinery and so on. A bond is the way to do it. You know the crop is coming, you can pay people back. It's a way of getting that money. The spread. So typically the first thing to check in the session when you come in and have a look at what the markets are doing, obviously you have your own watch list or whatever, but if you're trying to get a bird's eye view and go up in the crow's nest, understand what's going on, we can get an overview of the markets by looking at the bond yield curve and the spread. Well, what spread am I talking about? I'm talking about the spread, which is the difference between two bond yields. Yeah, so most typically the 2 and 10s. So a 2-year and a 10-year bond spread, we can monitor that for signs of confluence. When the spread becomes so thin that it crosses and inverts, we can know there is confluence, serious confluence in the bond markets, and that contagion will then leak into all other markets and lead the economy because it determines cash flow and the availability of credit. Additionally, bond yields, as we've mentioned prior, account for a large chunk of investors' portfolios, and especially pension funds. So imagine the contagion when a pension fund is now looking at reducing risk because those bond yields are not paying anymore. We're going to see massive changes in the markets. So yield curve flattens or inverts. When the yield curve goes flat, there is a possible uncertainty about the future. What do I mean? What's a flat yield curve? I mean that you put your money in the ground for a month or 30 years, there's literally maybe 0.1% difference. That would be a flat curve. Literally you put the money in for a month, a year, 10 years, doesn't matter, you're still getting, say, 0.5%. It's still a slap in the face. Maybe you put it in for 1 month, you're going to get 0.4. You put it in for 30 years, you get 0.55, something like that. That's a flat curve, right? There's no curve there. If it inverts, this is a good leading indicator. A recession is imminent within the next 2 years. It could be considered bearish. Why I say 2 years? Well, it could happen quicker, it could happen longer. It depends how long that thing inverts. Or it could be even 6 months down the road. I'm saying 2 years here because generally, if the bonds are going to invert, you're going to have a little bit of time in front while those shorter duration bonds coupons come in when they reach their full term. So basically, after a 1-year bond is now inverting of the second year of like bearish kind of outlook, then you start to see the SHTF, you start to see stuff really hit the fan and fall apart. Likewise, if the yield has been negative and inverts to a positive, we can take that as a bullish indicator. This would happen after a fallout, after the storm has passed, when yields have been really bad, went all the way down to negative. We can then see things start to come back. The sun shines after the storm, yeah? So a real life example of negative yields, we can find that in Japan or Germany as of late. Due to the disasters in Japan and uncertainty in the EU, we see this reflected in the bond market. If you weren't aware, there's been a lot of uncertainty in the EU, and German bonds and several EU bonds were negative. I believe they are positive right now. The disasters that happened in Japan hit the economy there very hard, and we see their bonds go negative for a long time. People are still willing to buy them because they believe in the future. They believe, why would you buy a negative bond? Well, because when it does finally go positive, you're going to have a huge amount of travel from your negative to that positive, which will bring you an ungodly amount of wealth possibly. But we'll see how that pans out. What am I looking for? So when you come into this, what are you actually looking for when you load those charts up? Well, one, you're going to monitor the bond yield spread. We talked about the 10 and 2s, and the curve to assess the current appetite and direction of the economy. Are we in an extension or a recession? Are we grow or are we not grow? Identify the changes in the bond yields and the ongoing trends and how they reflect in the market. So if a bond yield keeps changing and keeps going up and the government is saying they keep on doing these rate hikes, then we know we're in a bull market, right? Because we're going to keep on getting paid more and more and more for these bonds as we go over. So you go long the bonds and go long a whole load of things. If we know that we're talking about another, on the other side of the fence, that the rates are too high and credits got too expensive, then you're going to see people start to cut the rate, and we start to see possible recession. Or maybe they can control inflation by that, and we don't see an actual recession, but we see a slowing of the economy, and we see a weakening of the currency. So understanding that bonds are how we value currencies and control inflation and how the dollar gains strength, we can use this topology and get a top-down view of the world economy and the macro changes ahead of where the bonds are. So yeah, and I kind of just skip over that there. The number 3, the Fed rate hikes and central bank policy changes. So you can watch a key event there, the Jackson Hole Symposium, and also when the governor of the Bank of England talks, or the ECB or the Bank of Japan makes an announcement. That's tentative if you are interested in following this part of the market, because obviously any discussion of a rate hike or stopping of hikes or change of rates is going to have contagion and repercussion across all the markets. So finally, how do you actually trade this thing? Okay, sorry, and thanks for listening and staying on all this way. We're getting there. So number 1, follow the significant changes in the curve and spread to determine fundamental direction and to identify carry trades. What's a carry trade? Carry trade is where one country's currency to this counter pair is always in the money, or is going to continue going at a profitable rate, meaning one country's currency is only being issued at a APR of annual gain rate, annual percentage of say 0.5%, and another country's is going at like 5%. So you know that one country their currency is growing much faster than another. So therefore, potentially you have a carry trade. Things don't always work out like this because of the effects, which we'll go on later on this page, quantitative easing and quantitative tightening. But the carry trades are something that has been going on for a long time in the market, and it means that you can continually add into that long or short because of whatever way the currencies are geared, and it should be able to keep running for a long time. Because of volatility and the macro environment recently, carry trades can be sometimes a little difficult to access and are only available on exotic pairs, which a forex broker, retail broker may not make available to you because they are aware of that and they don't want people exploiting the carry trade. At the same time, when a carry trade gets too crowded, too many people are on the train, so to speak, you can see things just go all to pot and fall apart quite quickly. Same goes, if the bank suddenly comes out with a new announcement, the carry trade fizzles, then same reason. So don't take it as a sure thing that your carry trade is definitely going to keep going. But while you're in it is good. Keep a stop and keep following those profits. A tight spread is indicative of imminent change, inefficient markets, and underperforming economy. Tight spread, what am I talking about? I'm talking about 1 month and a 30-year literally have very little difference. You're getting a fraction of a percent difference. What's the point in locking your money up in this thing for any longer than you need to? Just put it in for a month and keep compounding it. Why would the bond yields be so low? Well, no one knows what's around the corner. That's why. So, Billy Big Balls ain't going to put all his money in the pot because he doesn't know what's going around the corner. This could be in times right now, like Brexit, Trump, election time, this kind of thing, war, any kind of uncertainty, then you're going to see this come up. Number 2, let's take an indicator on this. Bearish on a negative inversion. Yields drop, go south, it's bearish. Bullish on a positive inversion as the yields increase and we go north on the curve. Number 4, quantitative easing. What is it? Devaluation of money, increase in circulation, lower yields, right? We're just going to keep pumping our money out, cheap money, cheap access to credit, and not so much of a APR when you were looking for a savings or lock it in the ground, right? So number 5, the opposite of easing, QT, quantitative tightening. And that's higher yields, an appreciation of money, and a decrease in circulation, a control of inflation, essentially, to ensure that there is less money made available and it's harder to access. So let's actually go over and look at the chart and see what the hell is going on this thing. And over here, I'm having the bonds arranged for you on a background that is inspired by the Financial Times. So yeah, that's why I chose that color, to make it nice on your eyes. Here we have the red, yellow, and green, just like a traffic light, right? Can't make it any simpler than that. Red, it's a 2-year. The green, that's a 30-year. And the one in the middle, the amber light, the orange, that's a 10-year. Now we're looking at the weekly line chart from 2019, we're about to come into last month of 2018 now, yeah? All the way back, all the way back. So have a look at the history of bonds for a minute before we break the back of this thing, and let's just get into, let's get into it. It's quite a story to tell on the bond market. Our data is going all the way back into the 80s, right? We're not going to go that far back, but I just want to make a sort of, side point. I was born in 87. Look at the kind of yields people were getting back when I came in the world. Sorry, I don't know what I've done to the world, but it's been all down ever since. But yeah, you used to be able to get a 12% bond. What? Yep. Oh, how things change. Look at that. So throughout all of these dynamics, we can see this red line, which is the shortest period bond yield, right? We can see this red line sometimes come up close. This is a spread tightening, right? Remember I was talking about the 10s and 2s. That's the distance between this yellow line and this red line. That's your spread. Here we're getting a 30% spread or 28% spread, right? Up here, you're getting a spread of what? A couple percent, yeah? Fractional spread. So tight, loose, yeah? Okay, juicy, loosey, tighty, whitey, yeah? Okay? So you understand? Juicy, loosey, tighty, whitey. Easy to remember, yeah? So when we were in a juicy, loosey time, like there's a huge spread. When was that? 2003? Like the whole way through 2002, 2005, we had this like majorly slack market where like it was kind of ordered correctly, right? But what was happening just prior to that? It inverted. So it inverted here. The red line came up and went over the 30-year. You're actually getting paid to have your money in a 2-year more than a 30-year. Huh? Yeah, it happened. And it pretty much always happens after a ferocious run on the 2 years, which, of course, because of the ordering of things, everything runs together, and it just kind of gets a little bit fuzzy, like what the hell is going on today? And you're looking through in the year 2000. Now, obviously, this is the dot-com, the millennium bug, Y2K, right? Coming up to here. Back here, 95, lots of things going on back then. War and total different policy, right? But we had juicy, loosey, tighty, whitey, right? It's just coming up, falling down. Like I said, it's always an extension in the bond yield. They didn't actually invert here, but then it broke down. Like the spread got so tight, and then it came down with a tight spread all the way. It didn't really loosen up. It started to come down again, inverts. We could see it was quite flat here, and then inverting, and then breaking down, getting looser and looser and bigger spread. So one thing we see is that whenever it goes to these contraction, here's a contraction expansion, yeah, as we move through the years. Now coming more into the present time, so you have a good view of the history now. Look at the present. We're having a we have the year 2009 here, and all the way to nearly 2019, right? 2018. So 10 years, last decade. Much more relevant. What the hell happened there? Well, that's it. That's the Lehman Brothers. That's the cock up, right? That's the 2008. This is it. CODs getting piled in, all right? Debt getting accumulated, flattening, inversion, flattening, seriously flat. Look how tight it got, right? Yeah, inversion here, what the frick is going on? This is more than the 30 yield, what the hell? And then boom, down we go. And remember, the yields were pretty tasty by then. You'd get 5% no matter what you were throwing it at through the whole of 2006. What the hell is going on in the market? So do you see what I'm saying? Some people knew what was going up in 2006. They're not so short-sighted. They knew something was coming up within the next year, right? Smart money is never dumb, yeah? The people who are buying these big bonds, they know what's going on. So here we have it. 2012 all through this, we've had basically like a widespread, pretty flat, with a little bit of recovery in the last half a decade. And we're going from very loose spread, very wide spread, yeah, to tight and close symmetry. Zoom in. So here we are in September, October, November, and December of 2018. What people are talking about now that is worrying them is that if this red line goes over this line here or over this line here, then we have an inversion and we could be triggering a recession. Now, it's been a real good bull run in the US stocks, so could we be ready for a down cycle now? Some people have been saying the EPS is topped out on the stocks. We're not going to see another quarter of growth, and it's not going to be coming. We're going to see some stagnation and possible neutral to recession. So let's just bring up the stock market as an overlay on this, so you can see how things fit together. This isn't scaled or anything, this is just an overlay. So you can see, and the purple line I've added here is Dow Jones Industrial Average. So the index has basically been growing ever since we had that flat, everything was kind of flat back here. Well, just zoom out. Yeah, so there we go. Like I'm saying, it's not scaled, so there's a bit of jumping around the scaling, so bear with me on that. That's just the only way I can get the overlay to work. So here we have the 2008 meltdown. People knew slightly ahead of it in 2007, so halfway through 2007 you see these bonds are just boom plummeting, and here we are, 2008, start of 2008. Yeah, we have this, it was a bounce, and then boom, by the end of the year markets have tanked. Dow Jones is a serious low, and we've just had a great expansive growth ever since, and everything's kind of got back in order and back in line, and we're coming up and it's good. Now, do we think that another sell-off similar to the 2008 is imminent? Some people do. Hopefully, I don't think people are crazy enough to take the kind of risks that they were doing back then, and no one's going to be overly into the high risk subprime loans again. I don't think that we'll see a repeat of that kind of thing. Although the populist current policy making and this like issue with like many populist topics, the immigration, the export import of trade tariffs, trade war, all these things, there's a lot of uncertainty in the market, but it is a different market to 2008. You can't really compare apples and pears. Of course, if these invert, we see sign of a recession. And right now we see the Dow, it made these great advances 2018. Was the start of the year. It was coming into the year, and then sold off and had another great run. Are we going to see another repeat of that and then see it like extend up further? Probably if the yield continues to stay in order, and maybe if we get a bit more of a spread, so there's a bit more of an incentive for people to load up their bond bags. But on the other hand, really from probably where we're standing now, a more realistic view is that the yields are really tightening, and we can see potentially an inversion here and it start to fall down. So thanks very much for watching, and hope you enjoyed that. And if you have any questions, please leave it in the comments. And yeah, we'll be back with more interesting information on the markets and so on. Thanks very much. Bye.